The US economic figures will, of course, provide a window into the future for the global economy as well. So let's get the perspective of Gerard Lyons of Standard Chartered. He joins me live now. Thank you very much indeed for speaking to us. So, of course, investors are awaiting this key jobs data looking ahead. What do you think we can expect? What do you think it'll tell us about the state of the US economy?
Well, I think the jobs data, like other US data, will show that there is a recovery, but the recovery is not gathering momentum. It's still a very fragile recovery. And as a result, I think the markets are right to expect the Fed to not only keep rates low, but maybe actually do even more in terms of quantitative easing later this year. So the jobs data, like most other recent data, will show it's a pretty fragile, pretty feeble recovery. Remember, normally at this stage of a recovery in the US, things start to gather momentum, confidence picks up, companies invest, people spend. That's not happening this time because both people and smaller firms and smaller banks are still recovering from the debt overhang.
So there has been a great deal of speculation, as you say, about a further round of stimulus in the US, but central banks have already been printing money, interest rates are low, and the indications are that they're likely to stay low. What else can they do, and why would any future round of stimulus be any more effective than what we've already seen so far?
Well, the stimulus so far has been very effective. Basically, if we hadn't had the stimulus, the economy would have been in terrible shape. What we have is the tale of two worlds. We have a very strong, very buoyant East, a very fragile West. In the East, in China, India and other economies, there's a scope for policy to be tightened, and indeed in some countries it already has been. In contrast, in the West, in particular the UK, Western Europe and the US, the recovery is very fragile. Policy has to be kept pretty loose for some considerable time. Thankfully, in the States, fiscal policy has not been tightened, so that doesn't put as much pressure on monetary policy as, say, will be the situation in Europe or indeed the UK. But when we look at the US, it's still a tale of two worlds, even in the US. Big banks, big firms in good shape, small banks, small firms in pretty fragile shape. So the policy stimulus from the Fed has been fantastic. It's actually helped the recovery. Therefore, they need to actually keep more of the same and maybe even do a bit more on QE to actually keep the recovery going.
Gerard, as you yourself say, the recovery in the West has been so fragile in contrast to what we've seen in the East. You know, consumer spending is weak, job growth isn't really moving at the pace that we need it to. Really, the recovery that we were all hoping for just hasn't materialized.
Well, actually, the recovery is exactly in line with what we've been thinking here at Standard Chartered. Some people may be getting ahead of themselves. This is as good as a recovery as you could probably hope for in the West. It's actually not too bad. The scale of the debt overhang is quite considerable. US consumers and US firms, like British consumers, British firms, and some in Europe are actually starting to pay off their debts, increase their savings. The debt overhang still has maybe 2 or 3 years to run. So we're going to get a recovery. We're not going to get a double dip. But we're actually still going to have a pretty fragile recovery. Inflation is not the problem. There's no pricing power in many of these economies. Retailers, companies can't make higher prices stick. If costs pick up, it's going to be taken on margins. So against that backdrop, you have to keep interest rates low for some considerable time.
But if we do get a further round of stimulus, won't the debt overhang problem worsen?
The stimulus, if it comes, will come on the monetary policy side, probably not come on the fiscal policy side. In terms of on the fiscal policy side and the debt overhang, public debt, the markets are sort of fully on board with what needs to be done. In Europe, in the UK, governments are tightening fiscal policy, which will force central banks at the Bank of England and the European Central Bank to keep rates low. In the States, thankfully, fiscal policy has not been tightened at the government level. It's been tightened at the state level. So in the States, it's quite a complex situation. But in answer to your question, no, the debt dynamics in terms of the public sector are probably not going to get worse. What we need to work or focus on here is that in the private sector, there is still a debt overhang. Put it another way, in the last year, the economy was pulled off its knees by both the US Fed and the US government throwing the kitchen sink at the problem.
Right.
The big issue is what happens when that wears off.
So very briefly, in your latest piece, you contrast a buoyant East with a fragile West. Going forward, will we continue to see this divergence in policy whereby Asian markets will start to raise interest rates well before their Western counterparts? And what does that mean for the global economy?
Basically, the global economy is going to be led by the East. Basically, the Chinese, Indian economies are going to be pretty strong. Overall, we're going to have a recovery that is there, recovery helped by policy in the West, but Eastern economies are going to continue to outperform. No economy is decoupled from one another. If the West is not doing really well, that impacts the whole global economy. But within the global economy, the likes of China and India will outperform, and the Chinese growth dynamics will pull the likes of Germany along with it.
Gerard Lyons, Chief Economist at Standard Chartered Bank, thanks very much.